Well, the Asian markets, they are trading higher early this morning. Despite the cut that we're seeing on Wall Street overnight, the Nikkei is trading in the green. That's up close to around 0.3%. While the Kospi as well has put on some weight, and now that's gradually moved to the high point of the day. So that's up close to around 0.3%. Well, let's pull up the other couple of markets. We just got the initial rates coming in from the Taiwanese index as well as the Strait. And green on the screen, really. Yesterday, some of those markets did see a lot of selling pressure. Today, they're bouncing back up. And the Nifty yesterday was a relative outperformer. That was up close to around 40 points, while most Asian markets ended in the red. This morning, the screen is suggesting we'll build on those gains. So maybe a 20 to around a 25-point bump up just to kickstart trade.
Okay, the Asia in green, but that was not the case in the U.S. markets. The Wall Street ended lower as the tech stocks pushed the major indices lower after markets tried to regain footing after last week's losses. Now, the Dow ended lower by around 0.3%, whereas the Nasdaq was down about 0.8%, and the S&P 500 ended with cuts of around 0.6%. Now, tech shares fell deeply, where Apple as well as Netflix pulled back 1.8% each. CNBC's Frank Holland gets us a wrap of all the action on Wall Street.
U.S. stocks finishing lower today. The Dow losing 89 points, the S&P shedding 16, the Nasdaq off by 66. U.S. retail sales rose just 0.1% in September, buoyed by a rebound in motor vehicle sales, which offset the biggest drop in spending at restaurants and bars in nearly 2 years. Economists polled by Reuters were looking for a bigger rise there. The Commerce Department says Hurricane Florence may have dampened overall growth. Sears Holdings became the latest retailer to file for Chapter 11 bankruptcy after years of fighting to stay afloat in a changing retail environment. Eddie Lampert is stepping down as CEO effective immediately, but will remain the chairman of the board. Sears Holdings, which owns both Sears and Kmart stores, will close 142 stores by the end of the year. The Trump administration announcing the federal budget deficit rose 17% to $779 billion during the 2018 fiscal year. Spending jumped and revenues increased only slightly following GOP tax cuts. That jump puts the deficit at the largest since 2012. And that's the action from the U.S. market. Back to you in Mumbai.
Well, prefer a fundamentally driven market over a liquidity-driven one. That's a word that's coming in from Mohammad El Arian, Chief Economic Advisor, Allianz. He also adds that recession is highly unlikely to kick in amid the growth drivers. Let's listen in.
I have been waiting for a long time for this transition away from liquidity-driven markets, which is a nice short-term boost, but it's not genuine, to fundamentals. The minute we make that transition to fundamentals, three things happen. First, the fundamentals are divergent. So that's complicated. The U.S. is doing much better than the rest of the world. Second, there's a whole host of uncertainties. I mean, I've never seen a statement out of the IMF meetings with so many uncertainties there. And finally, let's not forget that liquidity is soothing and everything else. Fundamentals, you need to differentiate much more. So for me, it is no surprise that we're seeing this volatility. But over the long term, I'd rather have a fundamental-driven market than a liquidity-driven market. I don't understand those who are saying a recession either next year or the year after. You've got three engines of growth all kicking in at the same time. Government spending, household income higher, and therefore consumption higher, business investment higher. To get a recession with all these three drivers kicking in, you need a major policy mistake or a shock from outside. You don't get it otherwise. These are big engines all kicking in at the same time for the U.S., not for the rest of the world, for the U.S.
Okay, on that note, also hear out what expert voices from PIMCO as well as Oppenheimer Asset Management have to say about the factors driving the U.S. market and whether a recession is likely in the near term. Take a look.
We don't think we're we're not at the end of the expansion, but I think we're nearing the end of the expansion. If you look into 2019, you're going to see fiscal stimulus start fading. You're going to see, obviously, accommodative monetary policy start receding. And then, of course, what we've talked about many times before is trade policy risk. And that trade policy will not be a headwind to growth until really 2019. So, yes, so that is exogenous shocks. Trade policy could absolutely hit in 2019.
The biggest threat, of course, is the trade war business. If we go into a protracted trade war, that could trigger a recession. But the Fed has been remarkable about not making a mistake now for almost 10 years. We think it's because the Fed is more adept at gathering data. The sources from which it gathers data are more accurate because data today is more in real time than ever before. And as a result of that, the real risk, we think, is related to trade, but we think China is bound to come to its senses related to the need to upgrade its trade negotiation procedures. China is a major player, and it needs to come to the fore and treat its trading partners on that type of level, we would say.
Well, most European markets ended high in yesterday's trading session as concerns over Brexit and global tensions loom. The DAX ended well in the green. That was up more than 0.5%. The FTSE as well was up close to around 0.4%. The CAC, however, that was a bit of a relative underperformer. That ended very, very flattish in yesterday's trading session. Investors back in Europe, they're tracking a key summit tomorrow on the Brexit deal, which has remained unresolved over the past weekend odd. But if we're looking at some of those peripheral indices, well, the ATX is the market that relatively outperformed yesterday. It was up close to 100%. And I told you earlier that the Indian markets did well yesterday, but it was really some of those emerging markets as well that did put on some weight. You had the Brazilian index, the Russian index, both of them were up close to around 0.5% in yesterday's trading session.
Okay, so that was about equities. Let's shift focus to the world of currency now. The dollar index fell slightly in trade following a lower US market close. The yen also marginally strengthened against the dollar and currently trading at the 1.9 level.
All right then, and the world of commodities, crude oil prices, they're trading, closer towards that $81 per barrel mark.
Okay, it's time for a quick break. Welcome back. Well, on to the Wall Street then, where markets were on a buy on dips mode yesterday, with most indices ending near high point of the day. The Nifty and the Sensex gained 0.25%, while the Nifty managing to reclaim that 10,500 mark. Banks underperformed a tad bit. The index ended with a slight negative bias, but the mid-caps outperformed, with the index rallying about 1% to end above the 16,900 mark for that index. But how the queue set up for the trade, Nigel will tell us more. Nigel, take it away.
Well, Anisha, as we said earlier, that the US markets, they ended in the red yesterday, but the Asian markets, they are holding up today. So that's pretty good news because the SGX Nifty is indicating maybe there could be a flattish to a mildly green start just to kickstart trade. But yesterday was a good session. The Nifty recovered more than 100 points in the low point of the day. The Nifty Bank was up close to around 250 points from the day's lows. The two key montrables, really, that came to play yesterday. We had the dollar index, that cooled off a tad bit, and Brent crude prices, very, very importantly, when we started off the session, it was at around $81.5 per barrel. And that cooled off sub $81 per barrel. So that's telling you, what a key montrable it is, because the minute it dipped lower, that's where we saw a bit of a, run in the final hour of trade yesterday. The rupee dollar as well, if you pull up the intraday chart yesterday, you'll see that, in fact, at one point of time, it was trading above that 74 odd mark. That cooled off towards the end of trade because we did get the September trade deficit number. That came in at a 5-month low. You could say it is a one-off. You could say it is because of a higher base effect. But importantly, it came in at around $14 billion for the month of September. In the previous 2 months, we had readings of around 17 to around $18 billion. Now, can that help that rupee pull back a tad bit in today's trading session? That's going to be the key montrable in trade today. So the rupee closed yesterday around 73.83. One factor that will play out is the trade deficit number. The second factor that plays out is the dollar index has cooled off to around 95. Yesterday it was at around 95.5 or 95.4. So that's cooled off a tad bit. So can these tailwinds, both of them, come into play and help the rupee pull back maybe to around that 73.5 or, and more importantly, hold on to that level. In yesterday's trading session, the big stars really were the pharma as well as the IT stocks. There were a couple of pharma stocks that were gaining from the Nifty, but Infosys, that put its weight behind the Nifty, and that really helped the Nifty outperform in trade. But otherwise, it was a good session. Breadth of the market as well was good. Mid-cap and small-cap index did very, very well. But volumes are on the lower side. Institutional participation really was lower yesterday. By the end of the day, if you're a bull, you just want to see a marginal net buy number and you'll be happy. Institutional participation was lower. That's where you saw both the NSE and BSE cash market volumes, you put it together, it's less than 30,000 crores in yesterday's trading session. But as a bull, you'll say the FIs they bought, at least they bought 70 crores and they, they pulled back some of that selling. And it seemed that the institutions were in a bit of a selling strike because both the FIs and the DIs, both of them were buyers. They bought roughly around 350 crores. If you put both those two numbers together, you can call it institution participation was low. Maybe there's some exhaustion coming in from the FIs selling. Or maybe, in fact, the FIs, they said they've already sold close to 18,000 crore rupees in the month of October itself. That's nearing the worst we've seen in the last many months. In February, they sold nearly around 19,000 crores odd. But that's about the cash market. In the futures and options space, there is some shorting at the top. That's why the premium on the Nifty has come down to around 5 from around 15. That's telling you shorts coming in at the top. And the FIs, they unwound some of their long positions in an uptrending market. And they also piled on some shorts. That's not surprising, because the FIs are net short actually on the index. If you pull up the, the long and the short positions, that'll tell you the picture out there as well. But in an uptrending market, the Nifty ended higher, the VIX as well moved higher. This normally doesn't happen. They normally don't move in the same fashion. Since that happened, that told you that there was some big option buying. Both they were buying on calls as well as on puts, but there were more puts that were bought than calls in yesterday's trading session. But the biggest positive, Anisha, for me is the put writing that came back into play yesterday. Nearly around 16,000 contracts were written yesterday. That's telling you that the bulls believe maybe they're going to fight for this 10,300, 10,400 odd mark. Yesterday, the Nifty ended above the 10,500 mark, but the 10,400 mark added around 2.5 lakh shares. So keep an eye out on that front. The highest open interest as well is at around the 10,000 put. And as we saw last week, the Nifty has recovered from around the 10,140 odd mark. So with that as a stop loss, the bulls will believe maybe we can drive a tad bit higher from here. If you're looking at getting long on the index, though, remember we have rallied nearly around 350 points from the recent low. Another key point that came out yesterday, there were signs of some derating of PE. HUL Avenue Supermarkets, both of them trading at around 50 to around 70 times its forward earnings. Both of them, the numbers were more or less in line. But the street said we want something really superlative if you want us, to buy the stock at these levels. And both of them ended with cuts of around 2.5 to around 6%.
Okay, Nigel, thank you so much for explaining all those data points so clearly. But in terms of stocks, what are you watching out? Of course, there is a couple of big names reporting numbers today.
Infosys, it was a star yesterday. Has it done, factored in good numbers? Well, time will tell. Today we have those numbers at just post-market hours, I think. So we'll keep an eye out on that stock. Hero MotoCorp as well comes out with a set of numbers. And we have a couple of banking names that come out with a set of numbers. Jammu and Kashmir Bank, your Federal Bank as well, that comes out with a set of numbers. So keep an eye out on some of those mid-cap stocks as well. In terms of result reactions, India Bulls Housing Finance. The street was wondering whether or not they're going to keep up the pace in terms of loan growth. 27 to around 30%. Can they do that? Well, they did that. But is the best behind them? We'll have to keep an eye out on that front. Remember, the stock has seen a sharp correction from the top. So that one, a result reaction out there will be quite interesting. South Indian Bank, if you're just looking at the net profit number, the NI numbers, it was a tad bit better than what the street was working or what a couple of brokerages threw up. But the loan growth was the slowest in the last 4 quarters. The NI as well came at the 13-quarter low. So keep an eye out on that one. Delta Corp, well, the numbers were more or less in line. Top line growth, margin expansion as well. Profitability up by around 11%. So keep an eye out on that one. And we don't normally talk about this one. Smaller stock, PT Engineering. Revenues doubled, profitability doubled. So keep an eye out on those stocks. Infosys, Hero MotoCorp, both those two crucial numbers today.
Okay, so we're watching Power Breakfast on CNBC TV 18. Well, straight on to the macro data then. India's trade gap has narrowed to a 5-month low of just below $14 billion in September. Remember, over the last couple of months, we have seen the number close to $17-18 billion. So this is a bit of breather. Lata is here with more on that. Lata, is this good news or is it too early to say?
Oh, it's not a breather. It's a huge positive. Much more than... It's breather to the power of 10, if you please, or to the power of 100. We were running at a rate of $18 billion trade deficit for the last 2 months, August and July. And before that, we were running well over $16 billion. So it was when the second July month of 18 billion came in that you started to see the fall of the rupee. It coincided with the rise in crude prices. But that number is, if we had gone at an 18 billion clip, we would have reached a 3% current account deficit, and there were people even calling for a 3.2% current account deficit. 3 is normally the Lakshman Rekha. If you get anywhere close to it, then the currency starts depreciating. Now, this is the first post-depreciation number we are getting. So September was the depreciated currency. And we are getting an import number, 41 billion, or 41.8 billion, which is a good 3.5 billion lower than the August number. Exports are high at 27 billion. They look 2.5% lower than last year, but that was because last year, September, was a complete aberration. So don't go by that 2%. Exports, we did exactly what we did in August, which is the worry. We should have done a little more if the currency was cheap, but nevertheless, the big advantage of a depreciated currency is imports become expensive, so people start preferring domestic imports. And we have seen the expensive dollar help in two ways. We have consumed less oil, which means people are using fuel efficiently. Oil bill has fallen by $1 billion from 11.9 to 10.83, and, or rather 11.83 to 10.9. And gold has fallen from about 3.5 billion to 2.5 billion. Those are the $2 billion. The non-gold, non-oil imports have fallen by 1 billion. Now, we would have liked that to come from consumer imports, that is electronics imports, but that has not happened. Electronics imports have actually risen. So we are hoping, of course, that an expensive dollar will make it more difficult for people to import electronic goods because they're end consumption products, so they're not capital goods, they don't get into industry. That's the sum and substance. We have not done so well on exports, but that's okay. We've done extremely well on building an import wall, which makes import substitution and domestic industry, more competitive. Now, how will the market react? This came in the dying hours of the market yesterday, and so we saw the rupee appreciate from 74.04 to 73.83. But that is just not discounting the price enough because the granular details hadn't come. My suspicion is today we have quite a giant rupee rally on our hands.
Okay, so watch out for the rupee strengthening come in trade today. Thank you, Lata, for joining in with that perspective. But let's move on and talk about the top global oil CEOs that met Prime Minister Modi yesterday. Now, officials from the World Bank and the International Energy Forum were also part of the meeting, along with the top executives of the Indian oil and gas industry. Now, according to a statement released after the meeting, the Prime Minister asked the global CEOs to review the current payment mechanism to help provide relief to a weakening rupee. Now, the Prime Minister called on the global oil majors to invest in exploration in India and made a very strong case for a partnership between the producers and the consumers. CNBC TV 18's Manisha Gupta spoke to BP's CEO Bob Dudley after his meeting with the Prime Minister, and Dudley said that the oil prices currently are way higher for the entire world. Now, he predicted that the prices will eventually ease to levels of $60 to $65 a barrel in the long term. However, he does not expect any immediate drop in the crude prices. Take a look.
I think the world oil prices are way off the fairway of what's right for the world and comfortable. So they're very high now in countries like India, and I'll just name another big country, not as big, but Turkey, for example, all import almost all of its fuel. Is very painful. And then you have the strengthening of the dollar and the impact on the rupees. So at the pump, it's higher than it's probably ever been in India. So the concerns here are how long this will last. I always go back to the fundamentals of a market, supply and demand. Take away some short-term geopolitics here. The supply and the demand should keep an oil price, I think, 60, 65 is what we'll see. But it's not going to be tomorrow, I think. It's going to take some time. There are places in the world that are bottlenecked with oil production. The United States is one. There's a famous place called the Permian. Canada's oil is bottlenecked. There are other sources that could come on, as well as what Saudi Arabia and the OPEC countries do, but it won't be overnight.
Have to ask you about the technology disruptions and also the electric vehicles. There is lots happening in sense of transition. How do you look at the conventional oil and then, of course, these new disruptions?
Room for all of it. Electric vehicles are probably simply not going to change as much as people are assuming overnight. I mean, if you burn coal to produce the electricity that makes an electric vehicle, that's not changing oil demand, and I think they'll have less impact. It's great for the cities, particularly. We're absolutely supportive of electric cars and vehicles, and we'll be working, hopefully bringing some of what we're doing in mobility with Reliance and retailing, but that's not what I would worry about. I'm fully supportive of them, but it's not that kind of a dial changer.
What really has been the conversation with Reliance, the fuel retail space? Where do you see it the way it is?
Well, we want to get it right. Our teams have spent a lot of time together. It's always a matter of pacing, but this is not something for overnight. When you go into partnerships like this, it's decades and decades and decades. So our partnership with Reliance is great. We just got to get the right sort of terms here with retailing. I'm taking great comfort from this meeting that not price controls on retailing, because that's really makes it difficult. So I'm optimistic.
And Bob Dudley was not alone in talking about the fuel retailing plans for India. Saudi Arabia's Minister for Energy, Khalid Al Falih, who is also the chairman of oil and gas giant Saudi Aramco, expressed the company's interest in fuel retail in India. Now, he also talked about Saudi Arabia's contribution in keeping the crude oil prices under check.
Saudi Aramco's desire is also to invest in consumer-facing segments such as retail fuels and petrochemicals. We went out of our way to alleviate anxiety over supply shortfalls, and at the risk of accusations of reversing our production policy, we decided to increase production at last June's OPEC meeting to ensure there were indeed no supply shortages. This has averted a major price escalation.
Okay, let's talk more about the fuel retail, and this one is a cnbc TV 18 exclusive. The government has decided to set up a 5-member panel to review the rules governing fuel retail in India. Now, the review is being undertaken in order to attract more private sector participation in the sector. Anshu Sharma joins in with exclusive details on that. Anshu, good morning. Tell us more about the panel and the mandate that has been given to this panel.
Well, at a time when a lot of foreign companies are looking to enter into fuel retail business in India, we understand from government sources that government is looking to set up a committee of 5 members which will be headed by Kirit Parikh, which will look at reviewing the current existing guidelines for marketing fuel retail in India. Now, we understand that this committee will submit its report within 60 days, and the idea is to identify entry barriers for expansion of fuel retail business in India by the private companies, as well as look at the need, if required, to liberalize guidelines for fuel retail business in India to increase private sector investment in retail business of fuel. Now, we understand that BP, along with RIL, Nayara Energy, led by Rosneft, Saudi Aramco, are few companies which are looking at entering or expanding their current retail business of fuel. Now, please remember that Indian Oil Corporation has 50% of market share in retail business of fuel retail, and HPCL and BPCL have 25% market share. Now, the total retail outlets in India is close to 62,000 in India, and private sector only consists of about 6,500. So any changes in the guidelines or rules for ensuring that there's investment in India in this segment will be welcomed by a lot of companies. Back to you.
Watching Power Breakfast on cnbc TV 18. Now, a whole host of earnings are lined up today. You have Infosys, Hero MotoCorp, as well as Federal Bank. They are set to report their numbers today. And we have with us Rima, Sonia, as well as Abhishek, taking us through the key expectations. Good morning to all of you. Rima, you go first.
Hi, Nigel. Good morning. Well, the numbers will come out post-market. As a quick run-through of the basic numbers, dollar revenue growth seen higher by 2.3%. Constant currency growth should see a sequential improvement of 2.8 to 3%, lower than the 3.7% that TCS reported. Margins will see an improvement of 60 to 70 basis points. The entire impact or benefit of rupee depreciation will not reflect in Infosys margins on account of the fact that the company is making investments in digital, and there could be a wage revision for this senior employee. So TCS had a 150 basis point margin improvement, but for Infi, we're expecting about 60 to 70 basis points. But that will drive a big jump in the company's profitability. And remember, in the prior quarter, their profits were negatively impacted because of a write-down that they had done in one of the acquisitions. The big question is on their guidance. FY19 constant currency revenue guidance of 6 to 8% likely to be maintained. Their margin guidance for this year stands at 22 to 24%. Most believe it will be maintained, but there is an outside chance that the company will look to revise it higher to factor in the benefit of the INR weakness. Most actual estimates for the full year margins that Infy is likely to report are closer to the upper end of the guidance, 24%. In fact, Goldman Sachs even expects it to come in at 24.7%. The key things to watch, the INR impact on margins, is the company passing it on to the clients. Will they look to increase the wage revisions in order to arrest the attrition? Secondly, the pickup in digital. TCS reported a 60% jump in their digital revenues. For Infy, it currently contributes about 28.5%. Thirdly, can the company continue with that $1 billion of run rate deal wins that they enjoyed in the prior quarter? Fourthly, BFSI didn't do so well for Infy in the prior quarter. It saw a decline in the revenues. That needs to pick up for the company to fire in terms of its revenues. And finally, on attrition, because this quarter saw the CFO, Ranganath, resign, and plus their quarterly attrition stands at 23% versus 10.9% for TCS. So that's a very high number and a worrying sign. So any improvement there will be closely watched. With respect to the stock, it's off about 10% from its lifetime highs. It is trading at about 16 times forward multiple, cheaper than TCS, which is currently hovering around at 19 times. Back to you.
Okay, Rima, thank you so much for that. But do remember the stock already rallied around 4% yesterday intraday. Let's see whether the numbers live up to that or not. But what might be a tad bit disappointing is the number from Hero MotoCorp. Sonia, good morning. You have been telling us how the volume growth has really slowed down for Hero MotoCorp. Will that reflect in the numbers as well?
Oh, absolutely. The overarching theme for Hero MotoCorp this time is a slowdown that we've seen in growth because of a weak consumer sentiment, lower rural offtake, as well as higher fuel prices. Now, all of that put together has caused the volume growth to come in at just 5.4% on a year-on-year basis. This compares to about 14% last quarter and 24% in the quarter before. Of course, it also comes off a higher base, but the main theme really is the slowdown that we've seen. That will lead to a revenue growth of single digit. We're looking at a 7.2% year-on-year revenue growth coming in at a little under 9,000 odd crores. Now, on the margin front as well, we're expecting a 200 basis points fall in margins to come in at about 15.3%. That's because despite price hikes, the company could not offset the higher commodity costs and other ad expenses that they had to incur. So they did undertake price hikes, because of which realizations will go up. We're expecting realizations to rise about 2.5% year-on-year and 1.3% quarter-on-quarter, somewhere to the tune of 42,370 rupees a unit. But the margins will fall because of the commodity cost pressures. So this time we're expecting the margins to fall to 15.3%. If you look at the average trends that we've seen in margins over the last 6 quarters, this will be the lowest margins that the company has hit since Q4 of FY17. Now, all of this is perhaps being factored into the stock as well. The stock is down almost about 25% since the start of 2018. It's now trading at 12.6 times FY20, which is cheaper than its historic multiples. Also, another thing to watch out for will be the expiration of the Haridwar plant tax benefits, and that will impact profitability as well. So all in all, a weak quarter expected.
Okay, all right. We'll watch out for that one then, Sonia. But from the banking space, well, we'll watch out for numbers coming in from Federal Bank. Abhishek is with us to take us through the expectations. Abhishek, over to you.
Good morning, Nigel. So what I'll be focusing on is the impact of Kerala in terms of, the book of Federal Bank. Remember that more than 45% of the business, that is deposits plus advances, actually come from the state of Kerala. And we saw yesterday 2 banks reporting numbers, which was IndusInd and South Indian Bank. Both have restructured their loan or the exposure in the state of Kerala, which was affected by floods in Q2 FY19. So South Indian Bank restructured about 104 crores, IndusInd Bank about 111 crores. So the impact of Kerala floods will be seen very closely in terms of Federal Bank numbers. The net interest margin about 3% will be positive. Last quarter it was at 3.12. Loan growth will come down. The impact was seen in South Indian Bank, wherein the loan growth was the lowest in 4 quarters, and it has come off. So this bank was growing at 22 to 24%. Expect loan growth to be below 20% for Federal Bank. The gross NPA movement will be seen closely. Now the Q1 gross NPA was at 3%. Our post suggests NII growth of 11%, which is the lowest in last 5 to 6 quarters, while net profit to be down around 10%. Back to you.
Okay, Abhishek, so that was about Federal Bank. We will watch out for the impact that Kerala floods might have had on that particular stock. But Indiabulls Housing Finance also reported numbers yesterday. Now, given the hiccups in the last 10 days of the quarter, especially with the liquidity crunch on the financial space, how were the numbers and overall how was the loan growth when it comes to Indiabulls Housing Finance?
Well, Anisha, good morning. So to begin with, this has been a stable quarter for IndusInd Bank. Look at the loan growth. The loan growth has come in at 29% despite the fact that, as you mentioned, the last 10 days of the quarter went through hiccups due to liquidity crunch. The asset quality remains stable. Gross NPA was at 0.77 versus 0.78 in the previous quarter. The spreads were within the guidance that the management has been giving between 3.2 to 3.25. So it has come in at 3.24%. Overall, good set of numbers. You look at the NII is at 1,631 crores. That compares to our poll of 1,620 crore. The net profit came in a tad bit lower at 1,035 crore versus our poll of 1,074 crores. Back to you.
Okay, all right. Thanks so much for that, Abhishek. Well, we'll slip into a short break. On the other side, Manisha Gupta will join in with all the currency and the commodity market action. Stay with us.
Into Power Breakfast on CNBC TV 18. Well, let's talk about the space that's been making headlines, and that's the world of commodities and currencies. And Manisha Gupta, as always, joins us for more. Manisha, good morning. You have been at the Sarah Week. How's the mood, and what are they talking about in terms of crude?
Oh, well, plenty. And, most people are clueless on where the crude oil prices could get. We are getting to hear on how the prices are one event away from perhaps a 3-digit, and how the prices will come down to 70s and 60s perhaps in 2020. That is when you will see the balance come in, the supplies increase as well. But that, of course, is a longer-term view. For today, we have seen the crude oil prices inch back again. $80 seems to be holding well. The Iran oil exports have continued to decline. The latest count shows 1.3 million barrels per day. This is much down, actually half of 2.5 million barrels in the month of April. So the declines have been quite sharp. The geopolitics between Saudi Arabia just about continue. The journalist, not being able to being contacted, the U.S. and Saudi Arabia, the kind of conversation that's going on between the two countries also seems to be adding the premium. But what the markets would also want to watch is the U.S. crude inventories data, and there is an expectation that you would see a third straight week of increase in crude inventories, and that could put some pressure on the U.S. crude oil prices. Having said, Iran sanctions really seem to be the top talking point right now, and with the kind of people I have been speaking to, Sarah, we do say that even as India and Iran are holding conversations, there is nothing concrete really as of now, and as the 4th November deadline hits, you might see a lot of volatility coming in for the crude oil prices.
Okay, all right, Manisha, thanks so much for that. Well, everyone's going to be eyeing crude today as well, and Brent crude prices, when we started off the show, was a little below 80.9. Now, in fact, it's at around 81.05. So just keep an eye out on that front. In yesterday's trading session, by the time we wound up, Brent crude prices were trading well below $81 per barrel. And now, in fact, it's moved up marginally, not too much, but there's a bit of a move out there as well. So keep an eye out on that front as well. But Manisha just joined us and was telling us about the India Energy Forum Sarah Week that's underway in Delhi. In fact, she caught up with Dev Sanyal of British Petroleum and began by asking about the alternative fuels that are available for oil and where does he see India standing in this scenario.
Well, I think India is leading in some respects in the area of alternative energy, not just fuels, but energy broadly. And when I look at the ambition India has set in terms of the number of gigawatts, in terms of solar, the renewable mission, I mean, India is just doing a lot more in this space. And I think the level of innovation, the cycle time in terms of technology improvements, the application of digital, and frankly, changing consumer patterns as a result of the way we are actually thinking about energy moving forward is, I think, essential. When you take a step back, India needs a lot more energy. 165% more energy. Compare that over the next 20 years. Compare that to China. It's around 61%. Compare that to Brazil, it's around 40%. Compare that to Russia, it's 8% growth. So India is growing very fast. We think that over the course of the next decade, the growth rate in India will outstrip China in terms of energy demand. So I think what India is doing is reimagining the world of energy in some respects. And renewables alongside gas is going to be incredibly important as we look at the future in terms of the energy mix.
What is the number right now that we are working with? I understand it's quite minuscule when you look at a comparison to oil imports and the kind of consumption that there is. But with the work that is being done, what is the pace and how soon do you see we actually making a meaningful number here?
I think when you look at the overall mix from 175 gigawatts by 2022, it's been now actually increased to 225. that tells you there's a massive shift that's taking place. I think the key is going to be, how does India continue to make progress in that, but also leverage the gas economy, because ultimately renewables, the challenge is when the sun is shining, when the wind is blowing, it's great. When it's not, what do you do? Now, we are seeing a lot of improvements in storage solutions. The fact of the matter is we don't have a large-scale storage solution that can actually be the perfect complement to renewables. So gas, therefore, is very important. But at 175 or 225 gigawatts over the course of the next few years, that's a massive improvement, you know, far outstripping what we're seeing anywhere else in the world. But of course, India just needs a lot more energy because India is going to become a lot more prosperous. And that's actually a good thing. The question, therefore, is how do we manage this in the future? And I think at 225, 175, these numbers are still sort of small in the context of displacing the system, because ultimately, when you get to a sort of 40% penetration without storage, there's a challenge. And therefore, we are still shy of that, but the growth rates are, you know, the envy of the world, quite frankly.
Power Breakfast on CNBC TV 18. Well, to just recap this morning on all the cues that are stacked up, the US markets, they ended with some cuts in trade. The Asian markets, though, they more or less ignored that. In fact, yesterday, some of those Asian markets ended with sharp cuts. This morning, the screen is green, actually, because all those markets, in fact, are trading with gains of around 0.7% to around 1%. Importantly, the two key parameters that we have been looking at, the dollar index has cooled down to around that 95-odd mark, but Brent crude prices, that's something that you should keep an eye out on. If you could just pull up the intraday chart, you'll see that that's spiked up marginally from the low point of day. So could that be a party pooper if it goes to around 81.5 odd? We'll have to keep an eye out on that front. For the time being, the SGX Nifty is indicating after 40 yesterday, 40 points is what we got. Maybe we'll see a 20-point bump up just to kickstart trade this morning. So keep an eye out on that front. But Mangalam's with us. He joins us this morning to run us through all the cues coming in from the derivatives market. Mangalam, over to you.
Well, Nigel, yesterday we saw a 40-point bump up after a big bump up that we saw in the previous trading session as well. So the Nifty reconquered that 10,500 mark, gained for the second day. Yes, the FIIs also bought, albeit a little bit, just about 68 crores in the cash market. But after 10 days of relentless selling, that is something which is a positive. However, during the day, we saw the Nifty futures premium actually turn into a discount as well, and it closed with just about 5 points as against 14 points what it was in the previous trading session. That was telling you that yes, there is a lot of selling in index futures, and selling there was. The data confirmed it. The FIIs, they sold about 1,200 crores in index futures, unwound a fair amount of long positions, 8,800 contracts, and added around 6,800 short contracts as well. So that's telling you that the FIIs who went into the series net short, 46% was the long exposure, have gone more short, and now the long exposure stands at 31%. So with the market moving slightly higher, is there a case for short covering or not is the big question. In index options too, there was a lot of positions of protection sought, because while the FIIs bought about 11,000 contracts on the long call side, they added 22,000 puts. So 2 puts for 1 call was bought, seeking some protection on the downside. However, the one thing that gives us some relief is the fact that the FIIs have been selling puts over the last 2 trading sessions. So that's indicating some bit of support at the lower levels. Yesterday too, we saw about 16,500 puts added on the short side. In terms of individual contracts, watch out for the 10,400 put. That saw some writing. 10,400 call was the one which saw some short covering. And at the same time, the 10,700 call has added about 5 lakh shares in open interest. In individual stocks, watch out for Infosys ahead of results. That stock was higher yesterday, saw some long positions added.
Okay, Mangalam, thank you so much for that. And a couple of more stocks that you should keep on your radar, that is Den Networks and Hathway, because the news just hitting our screens that Reliance Industry might be looking to pick up more than 50% stake in both of these counters. And the news can come in as soon as tomorrow and the announcement can be made. So keep an eye out on those 2 particular counters as well as Reliance Industries for the day. But on to our bullseye corner now. Our contestants this week, Himanshu Gupta, Samit Chavan and Vijay Chopra, are battling it out for the strongest portfolio. Let's hear their picks for Day 2 of the week.
The first pick for the day is a buy on Motherson Sumi. One can go long in the counter for a target of 264 and a stop loss below 240. The second pick for the day is a buy on Cipla. The intraday target will be 665 and the stop loss will be below 630. The third pick for the day is a buy on Bata India. One can go long in the counter for a target of 970 and a stop loss below 905. The final pick for the day is a buy on Adani Enterprises. for an intraday target of 162 and a stop loss below 145.
Our first call is a buy call on Vocard for target of 552, stop loss 499. Second buy would be on Banari Sugar for a target of 1840, stop loss 1638. Third buy would be on Bank of Baroda for a target of 107, stop loss 95.3. And final call would be a buy call on Cleach Drugs for a target of 185, stop loss 162.80.
My first call is a buy call on LIC Housing Finance. The stock closed at 447 rupees yesterday. It could be bought for a target of 455 and the stop loss of 435 should be kept on the stock. My second call would be a buy call on Adani Power. The stock closed at 34.85 yesterday. It could be bought for a target of 37 and a stop loss of 32 should be kept on the stock. It would be again a buy call on Amara Raja Batteries. The stock's closing price was 763. It could be bought for a target of 775 and a stop loss of 750 should be kept on the stock. And my final call would be a buy call on Adani Enterprises. The stock closed at 152.45 yesterday. It could be bought for a target of 158 and the stop loss of 147 should be kept on the stock.